I think my view here is you ought to look out 10 years. You ought to look at motions or movement in 1 year increments. So your term is 1 to 10 years, and the focus ought to be on trillion-dollar asset classes, not smaller things. So, for example, if you look at the 10-year compound annual growth rate of Bitcoin, it's 201% on average every year for 10 years. If you look at and there's $1 trillion in it now. If you look at gold, there's 10 trillion in gold. The compounded annual growth rate for 10 years is 1.88%. If you look at S&P 500 index, well, there's about $32 trillion of assets there. The compounded annual growth rate in 10 years, starting today, 11.6%. Big tech, NASDAQ, that's 18 trillion. You got 17% compounded annual growth. And if you look at the long bond, like 20 to 30 year dated treasuries, you would have got 4% in them over 10 years. So if you look at that and you step back, you say, okay, well, I get the trend. I don't really think it makes sense to actually make a macroeconomic or portfolio move unless you're looking out. Short term is 4 years. Long term is 10 years. If you're going to look at 1 day, 1 hour, 1 week, 1 month, you can look at 100,000 assets every single day, and you can generate millions of times as much information. It's all noise. It's like I take a microscope and I like zoom into your forehead, and if I get close enough, I'll find a blemish. I mean, it's
no doubt.
I'm trying to find something to give me anxiety. I will find it if I just look close enough, frequently enough, right? We have this challenge. There are people that make their living providing information. There's networks like Twitter that keep you with a dopamine hit. There are analysts, and they analyze soybeans versus corn versus futures versus swaps, derivatives, this, that, and the other thing. And they have to have something to talk about every day, every week, every month. We publish a newsletter. Okay, well, that encourages people to generate noise, but it's not signal. Here's signal. If you go look at the blue dollar rate, which is the black market rate of the dollar versus the Argentine peso from 2003 to 2021, it's gone from three pesos to the dollar to 150 pesos to the dollar. And it's just the dollar is strengthening against the peso every year. That's the trend. If you look at all the currencies, for fun, I look at the last 10 years of every currency in the world. The bottom line is a lot of them are collapsing. Most of them are weakening. A few are trading sideways, and then a bunch are capital controlled, totally collapsing, but no one wants to talk about it. That's the story. Now, if I come back to you and I say, Guy, you live in Argentina, it's 2003. I think the currency is going to keep weakening. What should you do? And the answer is, it doesn't matter what you do. You could analyze every company in Argentina and every bond in Argentina and every piece of real estate in Argentina and every swap and every derivative, this and that transaction. Nothing matters. The only strategy that makes sense is you convert all your pesos to dollars. You forward finance your cash flows to a loan in dollars. You finance all your fixed assets into dollars. You sell equity, which you convert into dollars. And you put the dollars into a bank and you get it out of the country. And if you do that, you'll be fine. And if you don't do that, a million other strategies all don't work, because fundamentally, all of your investments are correlated to a currency which is losing 15% of its economic value every year. And that dwarfs the execution of the CEO. It dwarfs any other strategy that a money manager could apply. And therefore, nothing that happened in Argentina for 15 years matters other than convert your money or convert your investment to a strong asset and put it outside the reach of a government that would forcibly convert it back into pesos and devalue it. I think the most pernicious pernicious mental model that people have is the idea that inflation equals CPI, and that number matters. And the number that really matters is cost of capital, which is the same as the rate of monetary expansion which is closer to the broad money supply or M2 money expansion, or another surrogate could be the S&P 500 index, or the average rate at which a market basket of every stock moves. When you look at those numbers, you get an inflation rate in asset inflation, which is 24 to 35%. Now, if you have an inflation rate of 0%, a company that's generating cash flow for the next decade can be discounted back and has value. When the inflation rate or the cost of capital goes to 8%, maybe it can have value as long as you leverage it up. But when the cost of capital gets to 24%, your utility has to grow its cash flows 24% because the value of cash in a decade is nothing, because it won't buy anything. And so what does that mean? The problem is the currency is becoming toxic to hold when the cost of capital goes to 24%. And what I'm getting at with that quote is value stocks won't hold value. They're not a store of value in a situation where the money supply is expanding 15% or 20%. Value stocks only work in a very low cost of capital environment. And so right now, people can't hold value in bonds because bonds are going to yield a 2% coupon against a 20% cost of capital. They can't hold value in gold because capital is running away from it. I mean, gold is a disaster. It's like up 2% a year for a decade. They can't hold money in value stocks because the value stocks can't grow faster than a 20% or a 15% hurdle rate. By definition, they're all low growth. So that means that everybody gets stampeded into super high growth stocks like Tesla or meme stocks or SPACs that are speculative, because fundamentally the monetary policy is dictating what investable assets can hold value 5 years out or 10 years out. Once you understand that the inflation rate that matters to you is asset inflation, not CPI, it completely changes your view toward portfolio theory and how you discount every single asset and what you do with your money and your time. If you have zero monetary inflation, maybe you want to own real estate, maybe you want to own a value stock, maybe you want to take the risk on a high growth stock, maybe you want to own a bond, maybe you want to try some venture capital, maybe. But when the money supply, the monetary inflation rate got to 8%, you kind of had to be leveraged if you're a value stock. You couldn't be unleveraged, and otherwise you buy companies that are growing 20% like Amazon and Apple, and it becomes much less choice. In the world where the cost of capital doubles again or triples, price discovery disappears for more and more asset classes. So perversely, it actually makes the portfolio allocation decision simpler. It's like, I know I can't buy negative yielding sovereign debt. Junk bond indexes are at 4 to 5%, and the risk of the bond failing is 4%. So I'm looking at zero yield on junk debt, no upside, only downside. I can't sit in cash. And so I can't sit in long commercial real estate because they all have a CPI cap in the lease renewal provision. I know they all do. So you're buying a long bond. So now I go off to stocks and again, the value stocks, that unless someone has leveraged them up, and the problem is they all got levered over the past decade. And so the only way to actually get a decent yield is super high leverage on low growth or super risky high growth. And that's what drives everybody into these new ideas. That's actually fueling the crypto fire.